here in Huntington Beach. And today I have with me Dave Averill from Dave Financial. How you doing, Dave?
I'm doing well, Mike. How are you doing?
Fantastic, fantastic. Just excited for another, start of September and getting into that finishing of the third quarter and into the end of the year. It's an exciting time to be in real estate. So
Mike,
anyway,
yeah, we're busy over here and things are good. So let's do it.
all right, fantastic. Well, I thought you just kind of ask some questions because we've had some big changes and things are kind of moving in the bond market. We had an ADP job number data come out today, and it looks like it hit a 10-month low for the month of July. How do these numbers typically impact the mortgage rates on the short term, and what's different about how the market's reacting this time?
Yeah, good question. So employment is linked to inflation. There's a link there. More people are working, more people are probably getting raises, and that's inflationary. If more people are working, they're also spending more money, which can be inflationary. So a weak jobs report helps curb inflation, which helps the Fed make the decisions that it's going to make in the future, whether or not they should raise rates or lower rates.
So that number coming out a little on the lower side kind of indicates that we're heading into a jobs market, at least today, for those numbers, that it's going to be a little on the lighter side. So that indicates that bonds would react in such a way that would bring rates down. Is that right?
Yeah, that's actually right. So my mortgage rates move every single day. We go up and we go down. I got at least one reprice today for the positive, and we might see more reprices later on this afternoon. So my rates moved in a positive direction because of that report. You're 100% correct.
Oh, okay. And then
Yeah.
so we have an actual a different jobs report number that comes out. Can you explain the differences between today's ADP private numbers and then what's going to be announced tomorrow for job numbers?
Yeah, so there's different people looking at different jobs reports. Tomorrow's a Fed government report. Today, ADP is a private report. Both of them kind of looking at the same employment figures, but they
Hmm.
look at them in different ways. Kind of think of it as like two different polls. One is government based, one is private sector based.
Okay. So how closely should a buyer and a seller actually pay attention to back-to-back reports when given the data so close to each other? Do they usually reinforce each other, or can they send a little bit of a mixed signal to the market?
Because they're different, you might see a timing difference. So there might be, ADP might have a different figure this month, and then they might make some corrections next month. Same thing with the government report. So there's correlation. They should start adding up over time, and they'll build the same picture over time, but they might not paint the same picture on the exact same day or the exact same month. So there's
Hmm.
going to be overall, what I tell people is there's a bunch of different reports. They're all going to be slightly different, but kind of think of it as a basket of economic reports that will tell us what's going on with inflation. And that's what people could kind of be looking at. Don't look at one report, look at the basket of reports.
Okay. Well, and so as you already kind of said, like the bond market's kind of, reacts to each different one a little separately, even before the Fed actually makes a move. Can you explain why the bond yields move so quickly and what that means for mortgage rates even before the Fed officially makes any kind of recommendation or move?
It's a great question. I hear this one all the time. Kind of think of it this way. Mortgage rates are forward looking. So mortgage rates already anticipate what's going to happen with the Fed, with inflation, especially with inflation. The Fed, they look at past data. So they're
Mhm.
quote unquote data dependent. That means they're basically looking at what happened in the rearview mirror. And does that give them the confidence to act in the future? So securities is what mortgage rates are tied to. We're looking forward, and we're already, if sometimes we'll have a rate day, a Fed rate day, and the Fed will lower rates by a quarter. I'll get the phone call, hey, I heard rates went down today, and they
Mhm.
actually might go up a little bit on my side because we already priced in everything that the Fed did. If they don't put a little bit of extra juice, we may not go down on that day. We may actually go up.
Well, and that's on my side of the equation. I'm sure you see this when you work with buyers. Right now, it seems to me that some buyers are saying that they want to wait until the Fed makes some kind of an announcement. That's coming next on September 17th. So, from your perspective, could waiting actually backfire to these guys? And how do
Yeah,
those market trends kind of behave leading into and right around and even right after a Fed rate cut announcement.
Right, right. So I tell people about a year ago, there's been talk of rates coming down for about a year. One of the little sayings we have is, buy the house, marry the house, and date the rate. The hope being that interest rates come down and you get a better interest rate in the future. People that wait, I think their hearts, and their mind is definitely in the right place. You definitely want a lower rate. Everybody does. It helps with purchasing power. But when a slew of buyers come back into the market who have been waiting, you're actually going to have more competition. You're going to have fewer homes to choose from. Who knows? Home prices might actually go up at that point. On top of that, as we just talked about, interest rates might actually go up on that particular day. So, what people were hoping for a year ago, they actually didn't get, and we're maybe going to see it again this cycle. So, people who are waiting for that lower rate didn't get it, and they actually saw rates go up, say like
Right,
6 months, or rates were going up instead of
right.
coming down. Now we're finally coming down, and we hope it. If I can say one more thing, what they want to do is they want to be buying now while home prices are cheap. And then the financing is temporary. So they're just dating the rate. If they buy now at a lower price and then they get the rate in the future, it's win-win, in my opinion. Is that what you're seeing, Mike?
Yeah, I mean that's exactly right. I mean, a lot of buyers that are considering waiting are kind of are getting faulty information, if you will, because they think that somehow the Fed rate is tied in with the mortgage rate, but clearly the bonds are the one that dictates that on a day-by-day basis. And so when an anticipation of the Fed making a move, then all of a sudden the bonds do react, and they're making that adjustments before the meeting. And then at the time of the meeting, if it just comes in with what they were expecting, oftentimes earlier this year is a perfect example where the interest rates had started to come down, 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 and then they did make a move. And really for the next 2 months, the interest rates actually for mortgages went up. And so I would say the same thing, like just for buyers, just don't worry about it. You have to live somewhere. And so we've been coaching people to utilize the lower rates. FHA's got good rates. You could even utilize a 7/6 ARM that are in like mid fives right now. It's fixed for
Yeah.
7 years. So the products like that could potentially help them get that lower rate, which translates into affordability, and then that's what's kept it. But we've also seen other dynamics in the marketplace where buyers have actually gotten to a little bit more inventory to choose from. And so they've kind of slowed the process down so they don't have to buy the first thing. They're not in a ton of competition. But at the same time, there's not a plethora of inventory that it's so gluttonous that they can just watch and wait for the pricing to come down. But that's, we're seeing still pretty firm, stronger prices. Not necessarily. The home has to be in good shape and it has to be priced right. And so the homes that are really selling right now are either total dogs or they're very nicely fixed up and they're priced right. So that's kind of what we're
Right.
seeing. So what would be like your parting advice to any buyer that might be seeing this or any seller that might be seeing this right now?
Right. I can't remember the last time we saw softness in the market. 91% of markets going back to 1942, real
Mm,
estate goes up. You and I think for the last few years have been asking, when is there going to be inventory and when are prices going to stop going up?
right.
This is that little window. And I don't think it's going to last very long, especially if interest rates come down. So my
Right.
opinion, if you get into a 30-year fix today, this is going to be the highest interest rate you'll ever have because you're
Right.
capped. If interest rates come down, you win. You get a lower rate in the future, but at
Right.
least today you're locking in something today that's going to be your guaranteed rate. Let's say interest rates go up 3 years from now, 5 years from now, and they never come down. You've got a
Yeah.
good low rate. One thing that people sometimes forget is during the Biden administration, when we were seeing inflation, when we saw interest rates go from a 3% all the way up to a 7%, home prices didn't stop going up during that time. Home prices still were marching higher even as interest rates moved up. The
Right.
two correlations there, one thing that usually happens is every time the Fed comes into a cutting cycle, which I think we're going to be seeing here, that's usually when home prices go up. So buy
Mhm.
now before they do that, and you win on both sides. Hopefully, you get lower financing, but at least you get a cheaper
Yeah.
home. It would be my final parting.
Yeah, and I would say this is that for those that are really waiting for pricing to come down. That's what they're really thinking, is that somehow with the job numbers or whatever, that pricing is going to come down with that. And certainly there are some markets across the US that really went up fast. Californians moved to Tennessee and Texas and other places, and Florida, and those markets really moved up quickly and fast. And now they're actually seeing some of the depreciation of that value. But in places like we're in Orange County, California. And there's not a ton of inventory. There hasn't been for a very long time. And guess what? There's nowhere else to really build a lot of homes that could really affect the supply and demand. So we're going to see a little bit of a subdued market. We peaked out about, I think it was about 5,100 homes in Orange County, and that was like, houses, townhomes, condos, and all of the markets that go within that. And in a normal market pre-COVID, we saw about 8,000 homes, which was a normal market. So even at our peak this year, we haven't seen the inventory levels of what we saw before. And just to give a perspective, back in the 2008 financial crisis, the peak of the inventory in Orange County was about 18,000 homes. And so we're nothing near that. And that's where significant price depreciation was happening. But we're nowhere near the number of homes on the market that would give us that kind of piece. People are kind of sticking in their houses. They've got the low rates, so they're not really selling. So the only people moving around seems to be people that are new to the market and want to get into their first home or second home, or they're also looking to move around. There are more people that are selling a home and moving neighborhoods. So with the more inventory and a little bit less buyer demand, some of those sellers that would never have considered a person with a contingency to sell a home in order to buy their home before, when it was red hot, you never saw those sellers even consider. It was like all cash to close in 15 days. Don't even ask me for repairs. But now somebody comes along and they say, hey, I want to buy your house, and they make them a fair offer, and they're okay with the price. But then that seller is willing to take them as a contingency. So we're seeing a lot more. We call them bellers because they're buying, but they have to sell as well. So we call them bellers. And there's a significant opportunity for those people in this market as well that want to move locations or move up and down in size, bedroom count, and location and stuff. So are you seeing some of those that are getting pre-qualified?
Yeah, we definitely are. Definitely are. There's, people that have owned a home before know the potential for a home and are less fearful of coming in, less fearful to come into the market. So most of the people that we're helping right now are probably move ups or move downs. The first time home buyer, it's hard. And that's where, Mike, I appreciate you giving them the information, education they need. That's what we try and do to make that decision. But the bellers are definitely active.
Yeah, very good. Well, hey, I hope that this has been of value to you. We'll have Dave back on another time in this near future to kind of give us an update of what's happening out there in the mortgage world. Right now, it's Mike and Dave signing off. We thank you for tuning in.